I want you to slow down for a moment. Not because nothing is happening, but because something very real already has. This was supposed to be a quiet period. End of December. Holiday week. Low volume. Thin participation. Most traders assumed the silver market would drift sideways, exactly like it does every year. But while Western screens looked calm, the real market moved somewhere else. Because right now, silver in Shanghai is trading near $85 an ounce, while COMEX in the West is still showing prices closer to $79. That difference might sound small at first glance, $6. But in a global commodity market, a market that is not supposed to have regional price gaps, that spread is a flashing red warning. This isn't volatility. This isn't speculation. And it's not retail enthusiasm. This is price discovery breaking in half. In a healthy system, this kind of gap wouldn't last more than minutes. Banks would step in. Funds would arbitrage it. Metal would flow until prices aligned. But that's not happening. And when arbitrage stops working, markets don't stabilize. They fracture. That's the part most people miss. They look at the chart and think, this is about silver going up. It's not. This is about where the real price is being set. Shanghai is not a speculative hub. It's not driven by retail traders chasing momentum. Shanghai is where silver is used by manufacturers, refiners, industrial buyers, solar panels, electric vehicles, electronics, data centers. These buyers don't care about narratives. They care about delivery. COMEX, on the other hand, is a paper market. 90+% of contracts never result in physical metal changing hands. They settle in cash. That works until someone actually wants the silver. And right now, the physical side is speaking louder than the paper side. This is why Shanghai is leading, because price always moves toward where demand is real. When Shanghai pays 85, they're not expressing an opinion. They're revealing availability. And when COMEX lags behind, it's not because silver is cheaper in the West. It's because the Western price is still anchored to assumptions that physical supply will always be there, that delivery stress can always be managed, that paper claims can always be honored. Those assumptions are now being tested. This is not a collapse yet, but it is a signal, because whenever physical markets start pulling away from paper markets, history shows us the same pattern. First, the spread appears, then arbitrage slows, then inventory tightens, then confidence thins. And when confidence thins, price doesn't move politely. It reprices. That's where we are right now. Not at the end of the story, but at the moment where the system realizes it has a problem. To understand why this gap exists, you have to understand where power actually lives in commodity markets. It is not in who trades the most contracts. It is not in who publishes the benchmark price. Power lives in who controls the bottlenecks. China does not dominate silver because it mines the most. In fact, it's only the second largest miner globally. China dominates silver because it controls refining and processing. Raw silver coming out of the ground is not usable. It has to be refined to industrial grade purity. It has to be processed at scale. And for decades, China quietly built that infrastructure while the West focused on financialization. Silver mined in Latin America, Africa, and parts of Asia often passes through Chinese refineries before it ever reaches global markets. That makes China the gatekeeper. And gatekeepers don't need to announce power loudly. They just need to adjust flow. That's exactly what's happening now. Starting January 1st, China's new export controls take effect. Not a dramatic ban, no emergency headlines, just a licensing system. Only large refiners, producing more than 80 tons annually, can export freely. Smaller refiners are effectively locked out. This doesn't stop supply. It redirects it. Silver that would have flowed west stays east. Domestic industry gets priority. Exports become selective. And when supply tightens quietly, price reacts loudly. Shanghai reflects that reality because it clears physical delivery. COMEX does not. That's why Shanghai is paying 85, while COMEX struggles to defend 79. This isn't manipulation in the cartoon sense. It's structure. And structure always wins. Because when real buyers show up, buyers who must take delivery, paper prices don't lead, they follow. And right now, they're falling behind. For decades, COMEX controlled the silver price not because it had more metal, but because it had more leverage. Futures contracts, derivatives, cash settlement. As long as most participants accepted paper instead of delivery, the system worked. But that assumption is now breaking. On COMEX, over 95% of contracts never result in physical delivery. They're rolled, netted, or settled in cash. That creates liquidity, but also illusion, because liquidity without metal is fragile. Shanghai works differently. Contracts there are designed around delivery. Industrial users don't trade charts, they take metal. That's why the moment physical demand tightens, Shanghai moves first, and COMEX reacts last. Right now, COMEX inventories tell a dangerous story. Total registered silver, the metal actually available for delivery, has been falling. At the same time, open interest remains massive. That means more paper claims are chasing fewer ounces. For years, this imbalance didn't matter, because no one pressed the delivery button. Now they are. Once delivery requests rise, banks face a problem. If they don't have the metal, they must buy it. But buying pushes price higher. Higher prices trigger more margin pressure. That creates a feedback loop. This is how control slips away. Not in a crash. Not in a headline, but through forced behavior. COMEX is still setting a price, but it's no longer setting reality. Reality is being set where metal changes hands. That's why the gap matters. 79 on paper, 85 in Shanghai. That difference is the cost of belief. And when belief fades, paper loses authority. COMEX can delay. It can slow the adjustment, but it cannot reverse it. Because once physical markets take the lead, paper prices don't argue. They catch up. What finally breaks paper markets isn't speculation. It's necessity. Industrial buyers don't care about sentiment. They don't wait for pullbacks. They don't trade narratives. They buy because production depends on it. Silver sits at the center of modern infrastructure. Solar panels, electric vehicles, power grids, data centers, advanced electronics. There's no substitute that performs at the same level. Every new generation of technology uses more silver, not less. Solar demand alone now consumes a massive portion of global supply. New high-efficiency panels require significantly more silver paste than older designs. Electric vehicles use far more silver than combustion engines. Battery management systems, power electronics, charging networks are all silver dependent, and AI accelerates this pressure. Data centers require extreme conductivity, heat tolerance, reliability. Silver is non-negotiable. This demand is inelastic. If prices rise, factories don't stop. They pay. That's why Shanghai is willing to pay 85, because the cost of missing supply is higher than the price of metal. Now look at supply. Silver supply cannot respond quickly. Roughly 70% of silver is mined as a byproduct of other metals. Raising the silver price doesn't instantly increase production. New mines take years, sometimes a decade. That creates a trap. Rising demand meets fixed supply. And paper markets try to absorb the stress. They can't, because paper doesn't power factories. This is why physical premiums rise first. Why dealers pull inventory. Why export controls matter. Industrial demand doesn't cause price spikes overnight. It causes structural repricing, slow at first, then sudden. At this point, the question is no longer whether something is wrong. The question is how the system resolves it. Markets don't fail loudly at first. They fracture quietly. They show it through gaps that don't close, through delivery delays, through prices that exist on screens but not in warehouses. That's exactly where silver is now. When Shanghai prices silver at 85 and COMEX insists at 79, you're not seeing disagreement. You're seeing two different systems. One is pricing availability. The other is pricing assumption. And assumption always loses. Paper markets only work as long as confidence holds. Confidence that contracts can be settled. Confidence that inventories are usable. Confidence that price reflects reality. But confidence thins before it breaks. That's why delivery requests surge. That's why premiums explode. That's why arbitrage stops working. Not because people are panicking, but because they are protecting themselves. This is not a crash in the traditional sense. A real commodity failure doesn't look like prices collapsing. It looks like prices you can't transact at. Screens keep updating. Quotes keep printing. But inventory disappears. That's how paper markets end. Not with headlines, but with silence. Silver always exposes stress early because it cannot hide. It must be delivered. It must be consumed. It must be sourced. And right now, sourcing is becoming the constraint. This doesn't mean prices move straight up. Volatility will increase. Pullbacks will happen. But structurally, something has changed. Paper control is weaker. Physical demand is stronger. Trust is thinning. That combination doesn't resolve politely. It resolves through repricing, sometimes slowly, sometimes violently, but always eventually. This isn't financial advice. This isn't a call to action. It's a signal. And if you want to stay ahead of signals like this, before headlines catch up, make sure you're subscribed.